Thanks very much, Kev. A couple of questions had come in, and I'll just answer them quickly. One, people are asking if they'll get copies of the slides, and the answer is yes. Anybody who registered for the webinar will get a copy of the slides, so no problem there. And is the seminar being recorded? And the answer is yes, and there'll be another email going out with a recording of it, and you can watch it at your leisure if you can't stay on for the whole time. I'm going to take the next approximate hour and 10 minutes and go through the Investor's Guide to Thriving and talk about what's your investor personality, and hopefully we'll have about 15 minutes of Q&A at the end. So the question and answers are going to be done not through the webinar app, but through the Slido app. So bring up the screen very quickly here, and let's do a little bit of a test. For those of you who do want to ask questions, use the Slido app. So you go to slido.com, and it's very simple. You put in #W154, and it takes you to our webinar screen there. And when we ask for audience questions, we're going to do a couple polls throughout the presentation. You'll be able to participate in the live polling. This is the first time we've done this on a webinar, so we expect it to go very, very well. We've done this across Canada in the live theater presentations, and now we're trying it on the webinar. So you can go to slido.com. You don't have to sign up for anything. Just put in that code, and you'll be able to participate in the questions. Okay, so moving straight ahead, my agenda for the conversation over the next hour and 10 or 15 minutes, I want to talk very quickly about the science of decision making and some of the challenges that people have in terms of making those decisions. I'm going to talk about the 4 investor types. The whole idea of this presentation is giving you some insight into what kind of investor that you are and some of the mistakes that you can make. You're probably not aware you're making the mistakes. The whole field of behavioral finance and behavioral psychology is at the core epicenter of our decision making when it comes to a lot of things in life, but is in particular today we're talking about making investment decisions. Then I'm going to show you a little bit about the basics on how to get going with ETF portfolios, comment on some of the risks and opportunities that I see in the marketplace, and then finally we'll go to the live Q&A. So with that in mind, I want to quickly talk about the brain. I do a lot of fundraising for Alzheimer's and brain research at the Baycrest Hospital here in Toronto. It's one of the world leaders in brain science health. I participated in some projects with them where they put me into a functional MRI machine. So you can picture my head with a cap on it with all those electrodes shoved into an MRI machine, and they could actually see what parts of my brain are working. So when I'm making a decision and they're asking me questions, is it a cognitive decision? Is it coming from my frontal lobe? Or is it an emotional-based decision, which is based on feelings and instinct instead of fact? So mitigating these behavioral biases we have is a difficult task. But if we know what to look for, and hopefully after this presentation you'll have some insight into this, it's not impossible. And ask a very simple question to people. When you make an investment decision, do you want to make the best investment decision possible? And if I did a survey there, everyone's hands would go up, and I already know the answer to that. So I just want to do a quick three questions here. This is not for the Slido app, but are you cognitive or are you intuitive when you answer questions as it relates to mathematics? When it comes to making investment decisions, most of the decisions that we make have something to do with mathematics in terms of what's the probability of me making money versus me losing money. Okay, so these 3 questions were developed by an MIT professor, say 20 years ago. It might have been a little longer than that. And he asked these 3 questions of all the smartest students at MIT and Harvard and Yale and Princeton, And the average student, even though they're very, very bright academically, going to those schools, only about 20% of people got all three correct. So I'm going to read the questions out. You've probably read them already if you're watching online here. The bat and a ball together cost $1.10. The bat cost $1 more than the ball. How much does the ball cost? It takes 5 machines, 5 minutes to make 5 widgets. How long would it take 100 machines to make 100 widgets? And in a lake, there's a patch of lily pads, and every day the patch doubles in size. It takes 48 days for the patch to cover the entire lake. How long will it take for the patch to cover half of the lake? Now, in the first question, the intuitive answer, those of you who are answering by the primitive part of your brain, would have thought 10 cents is the answer. Because you think about it, the bat and the ball together is $1.10, and it's $1 more, and you immediately go to 10 cents and $1. But the question is, the difference is $1. So the actual answer is 5 cents, and the bat cost $1.05. The ball's 5 cents. Okay. Second question: it takes 5 machines, 5 minutes to make 5 widgets. How long does it take 100 machines to make 100 widgets? The intuition answer is 100. Those of you who are cognitively thinking about it in the right way, 5 minutes is the answer, because it doesn't matter how many machines you use, it still takes 5 minutes. And finally, the third question about the lake. The intuitive answer is typically 24, because you think about it takes that much to double in size. So you think about right away about half the number of days. But it doubles every day, so it's the correct answer is 47. Again, these 3 questions were asked of some of the smartest people in America, and on average, 21% got all 3 correct. So based on how you did on this test and being honest with yourself, are you more intuitive? Do you go more on gut feel? Or are you more thoughtful or cognitive in your decision-making process? The questions are structured to trick you a little bit. So I'm going to talk a little bit about the emotional brain and the self-defeating behavior that the emotional decisions when we make on our investments bear for us. So the 4 types of investors that I introduced on Berman's Call: passive, the follower, the return chaser, or the independent, the overconfident or the accumulator, and the conservative investor or the preserver. Those 4 investment types were categorized by a gentleman by the name of Michael Pompian. He wrote a book a couple years back called Behavioral Investor Types. That book has been introduced into the body of knowledge for financial analysts so that they get a better understanding of the whole concept of behavioral finance and behavioral analysis as it pertains to dealing with the end client. When you're your own end client by being a do-it-yourself investor, you make decisions to buy and sell securities on your own. A lot of you call Berman's Call, or you listen to, Jim Cramer, and you're looking at the financial media to get an idea of what you should be buying and adding to your portfolio. When a market goes up, everyone's relatively happy. When the market goes down, we get all stressed. In other words, there's volatility in the markets. There's a firm in the U.S. called DALBAR, D-A-L-B-R. Every year they do a study of the Investment Company Institute data, and they take all the buy and sell transactions that everybody does together in mutual funds or ETFs, and they calculate, based on all that transaction, what your realized return was compared to the buy and hold return. Over the last 30 years, and in fact in any time period you want to look at, the buy and hold return significantly beats the active return. So the emotion that drives the vast majority of our investment decisions, specifically when we see something going up and we want to get some of that, and you buy high, and then you put your stop in and it doesn't work, and you stop out and you sell low, and you buy high and you sell low, and you buy high and you sell low, that's what causes this lack of return. Dalbar estimates about 5 percentage points per year in the long run is attributed to the emotional cost of investing, i.e. panicking at the wrong time, etc. and then the balance would be the cost of trading in there. And you can see the comment at the bottom on their most recent report. Let me get right into the individual investor types, and I want to specifically focus on the orientation of the investor and the bias that really generates these buying and selling decisions. Generally, the follower has a lack of interest in investing. They know they need to invest for their retirement, don't really care that much, don't really know what they're doing, and they typically need to work with someone to help make them make these decisions because they're just not clear about it. The biases that impact you most are framing, so you get easily misled by advertising and things like that, and recency, which means you react quite often to things that are in the news and you don't take a longer-term strategic methodology in terms of selecting your portfolio. In other words, you lack discipline to go for the long game, and it's the long game that's really important. So your errors tend to be cognitive versus emotional, this type of investor. So here's where we're going to start using the Slido app shortly, and I'll get into some of these questions. For these two questions, we are not using the Slido app, but as we go through the presentation, I will periodically ask for people for their feedback on Slido. So just think in your head for a minute here. I've got two questions that I want to ask with regard to framing. So would you rather have an 80% chance of reaching your retirement goal or a 20% chance of outliving your money? There's no right or wrong answer for either one. Just get the sense of how you would respond to that. Question number two, would you rather have a 10% chance of losing 40% on an investment in your portfolio and a 90% chance of making 10%, i.e. your portfolio holds different things, or would you just rather have an expected return of 5% over the next year and not really think about the volatility too much? Okay, so I should say the answer to both of these questions are identical. It doesn't matter whether you select A or B. I'm actually asking you the same question. I'm phrasing them a different way to see in question A if you're much more of a positively focused, optimistic person, because picking A, you would much rather have an 80% chance of reaching your retirement goal compared to a 20% chance of outliving your money. But the reality is those two things are the same. Okay? If you don't reach your retirement goal, you're going to outlive your money. Okay? So they're the same. Now, the more negative people that would pick B are going to tend to be the ones that have a bit more emotion, a bit more anxiety about investing. You would much rather have a higher probability of reaching your goal, but based on how I asked those, I'm framing the answer for you to get the right one. So typically, most people would pick A in that response. In question two, typically most people would pick B, although the way A is structured, it's the identical thing. A 10% chance of losing 40% means a net 4% loss in your portfolio, and a 90% chance of your portfolio making 10% would be a 9% gain. When you add the two of them together, you get an expected return of 5%. But there's a lot of volatility and noise in the way I've written that question, but it's no different mathematically than B. And most people would probably pick B in their portfolio, though the ones that would pick A are probably tending towards being a bit more of a gambler. So either way, again, no right or wrong there. Now what I want to do is actually bring up we'll bring up the Slido in a second. I want to introduce you to three ETFs, and I want you to tell me which one you would buy. So let's say this was an advertisement in the newspaper. Okay, so you have the three ETF funds. I'm showing you the gross return, so that's before fees, of 9.1% for the first one, and the next two are 10%. The risk is measured by the standard deviation of return, so the volatility of the portfolio, and then the cost in terms of basis points. Now, based on those three, we're going to bring up the Slido poll right here, and you're going to see in real time, hopefully if this works, which ones you guys will pick. So the responses are starting to come in now. And we've got about 500 people on the line. I have no idea how many people are going to be using the Slido app. So we maybe have about 80 or 90 of you registered online, which is what we can tell. So as soon as we get up close to that number, I'll call it here. Now, having said that, based on the way I structured the question, I know exactly which one on average you're going to pick. And when we've done this across the country, the results have been pretty similar. Okay. So that's pretty good right there. Okay, so let's go back to the question. So about 70% of you picked A, and I knew you were going to pick A, but the reality of these three funds is A is identical. Portfolio ABC is identical to XYZ. It's the identical portfolio because the risk levels are the same. Now the gross return is 9.1, but the net return, 10 basis points MER, is 9%. And in the third one, XYZ, 10% gross return, but the MER was 100%, so it's still a 9% return with 15% standard deviation. Identical return. The vast majority of you picked the first one largely because the MER was the lowest. And so a lot of people, when they get into ETFs, they've started to just look at the MER as the only factor they consider as to which one they buy, and that's absolutely the wrong thing to do. You got to do your homework. You got to look way deeper than that. So in Kevin's presentation, he introduced on BMOETFs.ca, there's a screener. And one of the things the screener can do, you can bring up two different ETFs of similar types. So I've got the Vanguard VFV, and I've got the BMO S&P 500 ETF, ZSP. Neither one of those has a currency hedge. And if you look at the explanation, they track the S&P 500. They were launched literally within a couple weeks of each other in 2012. The MER on the BMO fund is 11 basis points. The management fee is 8. And the MER and management fee are 8 basis points on the Vanguard one. So the Vanguard one is cheaper by 3 basis points. The vast majority of you, given that choice, would probably just go buy the Vanguard. But let's look at the results. Because Vanguard, often in a Canadian version of an ETF, holds a US ETF. And in doing that, there's a slightly extra bit of a cost involved. There are some foreign withholding issues. And typically, Vanguard uses a sampling approach in replicating an index, which means they don't necessarily buy all 500 securities. They might buy 400 securities. So there's a risk, and that's why they can keep the cost a little bit lower. There's a risk in tracking error, meaning the 400 of the 500 they picked may not exactly track the market, where in the BMO version, it's 100% replication and as a better chance of tracking the market. So even though the MER is a little bit more, the actual performance has been better. Okay, so that's really important to think about. You really need to know what you're owning when you're picking ETFs, and you need to drill down. Don't just stop at looking at the MER. Framing does that. When a mutual fund company puts an advertisement in a newspaper, they're framing you. They're showing you the fund that they want you to buy. Not that it's bad for you. It's probably very good because they're going to put a fund in there that has a pretty good performance. But they're going to present it in a way, and they're going to compare it to other things that's going to make you attracted to buying that. Obviously, they've got a sales goal or something that they want to reach if they're going to advertise in a newspaper. Okay, so the recency bias in that you're too influenced by current events. And so if you watch BNN all day, if you're watching CNBC Fast Money Show, where all the things that they talk about literally are what's moving now, right? So there was an ETF that was launched a little while ago to fill this need that investors have. It's a FANG ETF. It's got all the fintech companies and the Facebooks and the Alibaba and the Tencent and all the names that they talk about in fast money are there. Now, if you've seen this ETF over the last couple of days, you know it's been absolutely trashed because these guys aren't going to benefit at all from the U.S. tax plans that are being implemented. So that's something that you need to be aware of. Try not to be influenced too much by recency. Okay, so the independent investor, sorry, I should add on the recency thing, try to think long-term, more strategic. Don't just try to make fast money. It's not the proper way to construct a portfolio. It may be fine for some types, but if you're the follower, the passive investor, it's a bad idea for you to go chasing stocks that guys are talking about in the news. The independent investor is far more engaged in the investment process and quite opinionated on the investment decisions that they want to make, tend to be very active, and their risk tolerance is pretty high. The biases that impact the independent is a confirmation bias and availability bias. There are others, and I'll cover some of the others later in the presentation, but these are the two main impactful biases for you guys. So confirmation bias is the tendency of people to favor information that confirms their belief or hypothesis. People display a bias when they gather or remember information selectively or when they interpret it in a biased way. The effect is stronger for emotionally charged issues and for deeply entrenched beliefs. People also tend to interpret ambiguous evidence as supporting their existing position. So this is how it works in the market. You own lots of oil stocks and you live in Alberta. And for those of you in Alberta, you don't like this message that I'm delivering of late. Actually, I was getting hate mail on BNN in 2014 when I first turned very bearish on oil. I said oil was going to break the 100 and it was going to go down to about 70 or 75. You can go back and check the episode I said it on in March of 2014. Boy, was I wrong. It went down to almost $26, I think, at the low. So, and now I've been on record saying I think we're going to stabilize around 50 plus or minus $10 for the next 5 years. So if you own lots of oil stocks, you don't like my view. In fact, you don't want to even hear me say that because it bothers you because you have a different view. It's possible that your view's wrong. It's also possible my view's wrong. Whole point is that when you dig your heels in and have a view, you look for confirmation of your view. So if someone came on BNN or CNBC and said oil is going $100, you want to listen to that guy to get confirmation of why your view is correct. You don't want to hear why your view is wrong. Okay? You don't want to hear that. The reality is your view doesn't matter. What matters is diversification. What matters is building a portfolio that's long-term in nature and robust. What matters is generating the yield you need, chasing high dividend paying stocks, for example. Not the best plan because when oil prices collapsed, a lot of those good dividend payers cut their dividends significantly because they couldn't afford them anymore. So it's important when you're constructing a portfolio not to get caught up in this bias. If it's not working out, you've got to be able to move on and sell it and go to the next one. And I'll talk about some of those other related bias. So focus on understanding the risk first when it comes to owning something in a portfolio. I get a lot of questions on Crescent Point Energy. And that's the white line here. And if you go back at 5 years or so here, as we have on the graphic, you can see the volatility in Crescent Point. Now, when oil was good and everything was good, okay, look at how Crescent Point did. It still underperformed Suncor, and it still underperformed the broad energy sector, and it still underperformed the TSX. But people were buying it because they loved the dividend. Then the dividend pretty much got cut in half and then got cut in half again. And so companies with bad balance sheets, you know, when the underlying commodity, the management of Crescent Point may be exceptional, but they cannot control the underlying commodity. And so things like this in commodity-driven companies, and we have an awful lot of them on the TSX, the management has no control really except for hedging ability and that's hit or miss for most managements as to how they do in bad market environments. So when you ask the question, Larry, should I buy Crescent Point, understand that the ride's going to be violent in Crescent Point. When it's good, it could be really good. But a stock like this is not going to thrive over the next number of years if oil stays in the 50 range. Now, if I'm wrong and oil goes a lot higher, then there's much more upside potential. So that leads you back to your ability to forecast where prices are going to go. And I'm telling you, it's a mug's game. It's very, very hard to figure out where everything's going to go. Listen, I'm someone who specializes in forecasting and figuring out strategically where to be, and I'm telling you, it's the hardest thing in the world to do. Your most important thing when you're building a portfolio is to make sure you're diversified so that you can handle the ride. So when the bad periods come, you don't lose sleep and panic. Because in that Dalbar study, that's when you make the worst investment decisions, when your emotions are running high and you feel that you need to do something. It's actually a hormone that's being released in your brain, triggering your heartbeat to accelerate, and you just get anxious and you feel that you have to do something, and that's the time you make the worst investment decisions possible. Availability bias is doing things and far too many people don't do nearly enough homework. For example, I said on BNN in 2011, which I pretty much say at some point every year, that I'm expecting a 5 to 10% correction. You want to know why? Because a 5 to 10% correction on average happens every year historically. And I'm going to show you a chart on that. But I said that in 2011, and this guy stopped me on an airplane, and he may very well be on the conference call today, and asked me, he said, Larry, you said there was going to be a correction, so I sold my entire portfolio. And I went to cash, and now the markets are higher. What should I do? And I basically said, I changed my mind a few weeks after that. The Fed did QE and the markets turned, and we didn't get the correction. I think the market did correct a little bit. It was maybe 4.5% before it actually turned and started going up again. And so that's the thing. Like, going to cash is insane. Really, it's as a strategy. No pension fund goes to cash. Pension fund as a long-term obligation and as a need to fund a retirement. This is what you guys are doing by investing on your own. You've got to have a long-term thought. Now, if you can't handle the volatility when things lose, you're typically only going to sell after it goes down a considerable amount. And therefore, I would willing to bet if I did a survey, 20% of the people on the phone are sitting with huge cash in their portfolio, possibly for a couple of years now. I first turned really bearish on the outlook for the market after probably around mid last year, just before Brexit. And I've been wrong on that call. The markets haven't pulled back. In fact, they've gotten even stronger. So I've taken the risk down in my portfolio, and over the last year in my growth fund, it's up 15%. So I can still make money in markets, but you can do it defensively, and that's the whole point. So when you look at facts, so look at this graph. So this is a chart of the S&P large cap, U.S. market, S&P 500. There weren't 500 stocks prior to the 1960s, but U.S. large cap. And this is all the drawdowns. So picture a market high, and then the market comes off its high. That's what this is measuring on a month-to-month basis, again, going back to 1926, end of 1926, where we have daily data from. And you can look, and you can almost never see a period of a year or more, although there are some, where you've not had at least a 5% correction in that period. It's pretty normal to get a pullback of 5%. Now, if you look at the graphic and look at the last year or so, you don't see that 5% pullback. We'd have a couple 2 or 3% dips, but we have not had a 5% drawdown. And it's quite unusual that happens. Again, it's happened before, but it's pretty rare. In the early 1960s, when we first ran up into the peak of that secular bull market coming out of World War II, you had a similar period. And then from the mid-60s right through to the 80s, you had some terrible bear markets during that period. So, you know, I think we're kind of in a similar place now where we're due for a big correction at some point here. But again, I've thought that for a year and a half. The accumulator. You're very interested, you're engaged in your portfolio, in wealth accumulation, you're confident in your investment decisions, probably to a fault that you suffer from the overconfidence bias and the illusion of control. The accumulator tends to be someone who's done very, very well in business. They've been very successful in their career. They want to transfer that success into investing. But when things go wrong, they tend to get very, very emotional, tend to have extremely high risk tolerance, and you tend to be very, very active. So when we look at that, overconfidence bias underestimates risk and overestimates return pretty consistently. You tend to hold very poorly diversified portfolios because you know you have confidence in the outlook and therefore you make big bets. And you tend to trade too much, tend to trade excessively, just because you feel like you're in control of the decision-making process. I got to tell you, you're not in control. The markets are going to do what the markets are going to do. You can't control the outcome, and trading excessively is only going to cost you money, again, according to Dalbar studies. On average, it costs us all about 5% a year plus transaction cost, compared to just being passive and buy and hold. So a quick Slido question here. From 1926 to today, as you saw in that graph, the long-run average rate of return is about 10% for U.S. equities in any given year. How much do you expect your investments to return for the next decade on average? Well above 10, below 10, about 10, or above 10? Again, results here are pretty consistent to what we've seen across the country. 75–80% of you are about 10 to below 10, and a small handful are well above. Again, the above and well above, you guys are the accumulators, you guys are the confident investors. I have no problem with that at all. But you're going to suffer from overconfidence, and that's a bit of a problem here. So I'll talk a little bit more about that overconfidence. But the illusion of control, you know, a lot of people who play lottery tickets and you know, normally ask for a show of hands who plays lottery tickets. So I can't really do that very well online here, but I imagine many of you do play lottery tickets. Pick your own numbers versus a quick pick. Now, the odds of winning are identical if you pick your own numbers or a quick pick. But if I surveyed you, and the ones that pick your own numbers, you will believe that you have a better chance of winning because you believe in lucky numbers or whatever. There's no such thing as lucky numbers. You believe you have a better chance of winning by picking your own numbers. Statistically, that's a foolish belief. Okay? It's a belief, I get it, but it's a foolish belief because it's not real. So, like the markets, picking your own securities as an example, you have an illusion of control that you can beat markets. One of the slides that Kevin showed at the beginning was that over a 5-year period, not one portfolio manager from 2016 to 2012, that 5-year window, not one portfolio manager beat the S&P 500 on a 5-year view. So, you know, feeling that you can pick the winners and only the winners is a naive assumption. So the implication for investors here are pretty material. You tend to, again, run concentrated portfolios. You tend to believe you can pick the winners. When things go wrong, you get very emotional, and those are some of the bigger costs. So a dose of reality here, again, a Slido question. How many of you, how much do you believe that the securities you pick will outperform the market return? So little, if any, and some are the dominant ones. Some of you significant. Again, I have no problem with that as a choice. But so the reality is, so some with little, if any. So if you do the math and you look at buying an ETF, which is going to give you the index return, versus picking 30 or 40 stocks, which you need at a minimum to have enough diversification to get rid of the idiosyncratic risk of individual companies. The cost of buying one ETF, $9.95 at your discount broker, versus buying 40 at $9.95 each and having to trade a lot more in and out of the market to maybe beat the index return is a naive assumption on average. So it's far more expensive to do single securities than it is to do ETFs. Having said that, there's a cost to the ETF, an MER, and that could offset the cost of some of the transactions. But in another slide that Kevin talked about in the Beesborough study, confirmed by Ibbotson, about 90% of your outcome in your portfolio is asset allocation, meaning how many bonds do you have, how much cash do you have, how many stocks do you have, how many REITs do you have, compared to, you know, how much gold do you have, all the assets, compared to which securities did you actually buy. So if you have a 100% equity portfolio, if markets go down, you're going to go down. Okay, that's for sure. So you're typically going to freak out or not sleep at night once the markets are down a certain degree, locking in your losses and so forth. And those are the mistakes that you're going to tend to make. Following 40 companies, following their earnings reports, doing all that you need to do to run a proper diversified portfolio, there's a lot of work there. So a number of years ago, we did an interesting study, and we looked at the sorry, not a study, but we did on BNN, we did a portfolio makeover. And we asked people from across the country to send in their portfolios. And they sent their portfolios in, all great, and we looked at them, and the vast majority of you, vast majority ran concentrated portfolios, undiversified. If you were in Alberta, you had more energy. If you were in BC, you had a lot more junior mining stocks. If you were in Ontario, you had a lot more banks. And it was that simple, that you were overweight generally based on things that were available to you. You were concentrated, you weren't diversified, you were loaded up on big dividend payers. You were running portfolios that if I was doing that for you as someone who's a licensed portfolio manager who runs mutual funds, the securities regulators would be tapping me on the shoulder and putting me up in front of a panel and saying, "What are you doing? Okay, you're taking too much risk. You're concentrating portfolios." And so, you know, it's very interesting what people do on their own versus, you know, you don't need a license to open a discount brokerage account. And you can really blow up your financial future not knowing what you're doing. So concentrating on diversifying your portfolio and reducing risk. The reason I love ETFs, folks, is because it makes asset allocation, which is 90% of the solution, not security selection, asset allocation, so elegant. It's so easy to shift between consumer staples and consumer cyclicals. You want to own more consumer cyclicals, XLY. Its correlation to the S&P 500. This is a correlation matrix. And it shows you over the last couple years, and you can see the dates there, what the correlation is, or the relationship in terms of price movement between each sector of the U.S. market and the overall S&P 500. So XLY consumer cyclicals, stocks like retailers and restaurateurs that in the consumer, if you lose your job, you don't have to go to a restaurant, you don't have to buy the new sweater, right? If you lose your job, you still got to go grocery shopping and buy your soap to clean your clothes. So that's a consumer staple, XLP. So XLP has a lower correlation to the broad market or to the economy. Okay, So when you're bullish on the economy and growth and everything's good, you want more XLY in your portfolio. And when the outlook for a recession is high, you want more XLP in your portfolio. You want to rotate into the consumer, but more defensive. Utilities are the lowest correlation sector to the market. They're interest rate sensitive, meaning they have lots of capital and they borrow a lot of money to build pipelines, to create energy infrastructure for transmission of power lines, et cetera, et cetera. So there's a big capital cost to utilities. Financials, XLF, are also interest rate sensitive. But XLF compared to XLU has a very, very low correlation. In fact, it's almost zero. And that means you get maximum diversification by putting financials and utilities in the same portfolio. Now, if I put financials and industrials in my portfolio and looked at XLF and XLI, that's an 82% basically correlation, which means I'm not getting a lot of diversification by having those two in my portfolio. If you look at consumer cyclical, so consumer staples, XLP, and you draw the line over and looks at XLE, that's a 0.33. By adding those two into my portfolio, I'm reducing my risk, I'm lowering my overall volatility, my correlation of returns. So again, correlation of 1 means the two assets do the identical thing. They go up and down together. Up 10%, down 10%. Up 5%, down 5%. A correlation of -1, okay, and now within the world of equities, there's nothing that's negatively correlated. Everything's positively correlated, with the exception of gold and gold equities. And we'll see a little bit on that on the next screen. But within XLB, the materials sector, you have the gold sector. In the U.S. market, there's very little exposure there. But that will generally have a low or even slightly negative correlation to market returns. The lower your correlation, the more diversification you have. So a correlation of -1, if we look at other asset classes, now you see some negative correlations here. So ZUE in the BMO world is S&P 500 currency hedged. If you add international developed markets, the MSCI EFI ETF currency hedge ZDM, you're getting some diversification internationally, but it's not much. It's still 85% correlated. Emerging markets in Canada, because their commodity components tend to be a little bit less, more of a diversifier. USO, that's the oil energy, oil futures ETF. That's a lower correlation. Look at some of the currencies, the euro and the yen. They're negatively correlated to U.S. equities. There's GLD, there's gold. That's even more negatively correlated. TLT is long treasury bonds in the U.S. That's the most negative asset class next to the Canadian dollar. So the Canadian dollar actually, because of the flight to safety into U.S. dollars, when stocks go down, Canadian dollar, or the U.S. dollar, goes up relative to the Canadian dollar. So holding U.S. dollars as a Canadian is actually a good way to reduce the risk in your portfolio. So holding U.S. long bonds, TLT, is one of the best ways to reduce the risk in your portfolio. Okay, so would I buy U.S. bonds here for the yield? No, I hate the yield at 2.8%. It's a terrible investment. However, when stocks sell off, bonds are going to rally in all likelihood. Not a guarantee rally, but in all likelihood. And so looking at the correlation between asset classes, putting them in your portfolio is going to help you diversify and understand risk a little bit better. And finally, the preserver. Okay, so your basic orientation is you're loss averse. You're very deliberate in your investment decisions to the point that you're too deliberate. You're too slow in making decisions. Wealth preservation trumps over growth, and risk tolerance tends to be the lowest of all the investor types. You suffer from loss aversion, and I'll tell you a little bit more about that, and the conservatism bias, or doing nothing, status quo, just taking too long to make decisions. You tend to be very, very emotional when you're making investment decisions, largely because of loss aversion. So in 1979, Daniel Kahneman and Amos Tversky got together. They've been partners at that time. They're Israeli psychologists. The two of them are the godfathers of behavioral finance. But they're not economists, they're psychologists. And they got together in the 1960s and did a whole bunch of studies around how people make decisions. And then economists got a hold of it, and they started to do other applications of how people make decisions. And this is how the whole field of behavioral finance was born. In 1979, they developed this thing called prospect theory, which won the Nobel Prize in economics in 2002. So it goes like this. On the x-axis of the graphic on the left side of the screen, you have gains and you have losses in your portfolio. And it doesn't matter actually whether gains or losses in your portfolio or they're gains and losses at a casino playing blackjack or poker. It doesn't matter where you're making or losing your money from. You get an emotional response. You have a psychological value. In economic terms, we call it positive utility or negative utility. But psychologically, it's you're happy or unhappy. So as you're making money, $100, $200, you have a degree of happiness. Compared to the same dollar amount of loss, you tend on average to be 2 times as unhappy as you are happy with the same value of gain. One of the tests they did to check this is say, if you wanted to make $500 on a bet, how much would you be willing to bet? And typically on a coin flip, 50-50, you would bet $250 to win 500. If that was the outcome 2-to-1, then you would play that 50-50 bet. Other than that, people on average didn't want to play a game where they didn't have a better payoff than 50-50. So that was what they learned, but people dislike losses more than they like gains. As you get more gain in your portfolio or at your casino table, your level of happiness doesn't increase. It actually starts to diminish. And so in market terms, we call this complacency. So in more modern times, they've tested this theory under functional MRI, and as I mentioned, I did a test under functional MRI, and they ask you a series of questions and they can see how you're responding. Chemically, it's no different in your brain as if you were making money in a portfolio, at a casino table, or if you were taking a hit of crack cocaine. Chemically, it's the identical response in your brain. You get a release of dopamine that comes from the amygdala, the emotional part of your brain. You get a high. You literally get a high. And you're happy with your win. Now, when faced with a loss, it's not a happy feeling, obviously. It's unhappy. It's not dopamine. You get a shot of adrenaline. And it's a hormone that gets released whether you're losing money in your portfolio, at the casino table, or if I held a gun to your head and took your wallet. It's the fight and flight mechanism. You get a shot of adrenaline. Your heartbeat starts to go up. You go into active mode. And this is what we call the whole fear and greed part of investing. Okay? Now, the thing with this is, the more money you lose, you don't get passive about it. You don't get complacent. You get increasingly unhappy. And that level of hormone keeps shooting higher until you can't sleep at night, and then you sell. Okay? And this theory, although it wasn't created for this, explains how markets work. So this graphic here on the right, in the blue line, is a total return chart of European Wisdom Tree Europe hedged ETF. And it was the first ETF that you could buy in Europe with a currency hedge. And the green bars, when they're above zero, are net money flow going into the ETF, so creation of new units. The red lines are net money going into the ETF, but in a down week when it's above the line. Red lines below are net money going out in a down week, and green lines below are net money going in on a down week. Okay? So this is the chart, and in 2012, Mario Draghi, who runs the European Central Bank, basically said, we're all in. We're going to fix Europe. We're going to buy bonds. We're going to do everything we can to stimulate. And they started doing some QE and long-term repo operations, and everything started to be okay. And then the Fed did more QE at that time, And 2013 was a great year for markets. And even though there wasn't very much global growth and earnings growth was only like 3 to 5%, the markets were up like 20 to 30%. And 2013 was a great year. So 2014 rolls around. All the Wall Street strategists start looking back and they're saying, well, Europe's fixed. So I'm going to buy me some of that. And every strategist on Wall Street started saying, sell US, buy Europe, do an asset allocation shift. But at the time, the euro was trading for $1.40 versus the US dollar. Currently, it's at about $1.18, and it was as low as 104. And if you didn't buy Europe as an American with the currency hedge, and when you're investing globally, currencies are the most important consideration, bar none, the most important consideration, you lost about 20 or 25% not being hedged. So you actually had almost no return if you bought Europe in 2014 through the middle of 2016 unless you were hedged. Now, because the euro went down in value. So in late 2014, 2015, a lot of money's going into Europe. Okay, so the markets are responding, they're going up. And then first quarter of 2015, Mario Draghi gives another speech, and he says it's not working. The data is deflation's still a bigger risk. We are going to have to go to negative interest rates. And negative interest rates are bad for the economy, and they're actually bad for the banks because of the negative draw on their capital. And negative, but what that did was even stimulate more because it pushed bond yields to negative amounts. And so banks could go out and borrow money for free, basically, which is absolutely crazy. CIBC in Canada issued a European note for 5 years at a negative interest rate in 2015. Not because they needed the money, but because they could get the money for free. It's absolutely crazy. In any case, so the markets in Europe, there's a lot of financial institutions, a lot of banks, very rich in their indexes there. Going to negative interest rates, bad for banks, money starts coming out of Europe. And it was all those people that flowed the money in late 2014 and 2015 that by the end of 2015 and into 2016 were starting to lose money and panicking. And then every rally we got in 2016 as things started to recover, they were still selling into the rally. Why? Because they wanted to break even. They wanted to get their money back. Oh, it was a bad experience. Okay, I want to get my money back, and I'm out. And now that we're seeing new all-time highs in Europe and European indices, we're seeing green bars come in on the upside. People chase returns. They buy when they should be selling, and they sell when they should be buying. We do it all backwards. And it's because of the emotional response to money that people have. That is the core decision-making process for everybody, and I don't care who you are, unless you have a rigid approach, statistical approach, and a diversified approach to asset allocation. The conservatism bias for this group of investors generally means they're underreacting to new information. And I give an example here of you bought a biotech stock because of a potential new drug. The results come out, they're not good. Stock gets cut in half. You don't know what to do. Why don't you know what to do? Well, you bought it on a tip based on what the guy said on BNN, and he was a smart guy and he thought he knew. And this one didn't work out. And now what do you do? And so your default is to do nothing because you really didn't do your homework. You really didn't understand why buying that stock. Is it going to help you diversify? Was it going to be a growth company? What were the prospects over the next 10 years? You just bought it on a tip. Okay, and buying things on a tip is actually quite bad. So the most important thing you need to understand when making an investment decision is this, and it's understanding risk and return. So would you play a game with me if we were to play all day and all week and forever that pays off 10 to 1 when the odds are right? So I want everybody on the line here, all 500 of you, to give me $100 and pick a number from 1 to 6. And I'm going to roll the dice. And those of you who win, I'm going to pay $1,000 to. And those of you who don't get it right, I'm going to take your $100. Now, who wants to play that game? In theory, everybody's hand. If you understand probability analysis, your hand should go up. In fact, you should quit your day job and play that game for the rest of your life. And in a couple weeks, you'll be the richest person on the planet. Because every 6 times I roll the dice, and let's assume I can roll the dice, it takes 2 minutes to roll it 6 times. So every cycle you go through, you're going to make $500. You're going to lose 5 times, 500, but every time you win, 1 in 6, you're going to make $500. So you're taking your initial bet and you're leveraging it up, and you just play that game all day. You keep playing that game, you'll be the richest person on the planet in 2 weeks. Okay, so you have to understand that. Now, when it comes to investing, evaluating risk and return is important. However, in investing, it's not a guaranteed return. The analyst price target is not a guaranteed return. The technical Fibonacci level is not a guaranteed return. The projection of a triangle breakout is not a guaranteed return. Okay? When you're evaluating risk and return, you must consider the risk of ruin. And many people tell me when they stop me on the street, we chatting, and say, Larry, you should change the name of your show to BermansCall. I really like your show, but you're always bearish. You're always negative. And I said, not the case. I'm actually a very optimistic person. But what I do is I look at the risk of the investment far closer than I look at the potential return, because I want to know if I can handle the ride. So if we were to play this game you win 5 times and you lose 1. If I were to pay you 10,000 to 1, but you got to play the game with me 6 times. Okay, $100, 10,000 to 1. Would you play that game with me 6 times if the chance is 1 in 6 that you're going to kill yourself? Okay? The answer should be no. Okay, now some of you might be risk takers out there and might go for it, and a couple of you would even win. But vast majority of you wouldn't win, and you would expire worthless, so to speak. In any case, when you're evaluating risk and return, it's really important to consider the worst case scenario. If I'm going to buy Crescent Point, what's my downside? Okay, knowing that, can I handle the ride? So I like to look for 2 to 1 or 3 to 1 return to risk ratio before I step into something. So when someone asks me about Suncor today, do I buy Suncor $43? I think the maximum upside's 45 in the next couple of years, and the downside's probably 35 or maybe a little bit lower. The answer is no, I don't buy it here, because the risk return just isn't favorable. Okay, now if it's at 38 and 35 is my low end and 45 is my upside, okay, I got $7 upside and a couple of dollars downside. Yeah, I want to buy it at that point. Okay, so that's the kind of analysis you need to do when you're saying, should I add something to my portfolio? There's a couple other important biases here that I'm going to cover very quickly. And one of them is called strategic reasoning. John Maynard Keynes, who many of you know is a very famous economist, he wrote a book in the 1930s called The General Theory. And in that book, he introduced the idea of game theory and strategic reasoning. So it's an important skill to have when making decisions. And this is a little test here to test to see if you have good strategic reasoning skills. Okay, so annual returns for a company WIN have been over 15% for the past 5 years, and we're going to use our Slido app for this. The companies in the fast-growing artificial intelligence sector and earnings have been growing at 25% annually. The CEO is a great corporate citizen. He donates 20% of his bonus shares annually to local charities to help reduce his taxes. Which is more likely to occur? The company will grow at least 25% in the next few years, or the company will grow at least 25% and the CEO will continue to donate shares to charity to reduce his taxes. So across the country, the average has been about 50-50, and I see no difference here. The average is the same, about 50-50. Okay, so here we go. Now, the probability of A working out is significantly higher than the probability of B. So what are the odds that the company continues to grow at 25%? Okay, well, it's pretty good. That's been a trend, so that's good. But what is the probability of the CEO also donating shares at the same time? So the odds of both those things happening are less than the odds of only one of those things happening. Okay, you follow the logic there. Strategic reasoning is very important. If a market runs up into an earnings announcement, there's a good chance that you're going to get a sell the news effect after the fact. Think about the game of chess. How many moves ahead can you think strategically to outplay the other guy? If I move there, what's he going to do? What's she going to do? If I move there, then they go there, then I go here. You know, think 2 or 3 moves ahead. That's what strategic reasoning is. It's part of game theory. It's an important concept for those of you who are active investors to figure out what the move is. So market runs up into earnings. Unless the earnings are way, way better than expected, the chances are that people are already in and you're going to get a sell the news effect after the fact. Same thing on the downside. If a market sells off going into an event, unless the news is really bad, so if the market sells off going into a U.S. election, the market's starting to discount some bad news. It doesn't mean it can't keep going down, but it's already discounting some news and so forth. And that's how you have to think a little bit about strategic reasoning as it relates to making investment decisions. Hindsight bias is a belief that past events are knowable, and it's pretty obvious after the fact that we should have made a decision. Unfortunately, you can't go back and trade yesterday's price, okay? But knowing a bit about history can help us. For example, what I consider market noise, because of that graphic that I showed you maybe an hour ago on the drawdowns in U.S. markets, 5% is noise. Don't care about it. Don't worry about it. It happens all the time, every year. Don't worry about it. But if you measure all the corrections over history that are 5% or more, it turns out the average correction is 13.4%. Now, there are some pauper bears when you measure the bigger ones. So if you measure all the ones that are 13.4% or more, they average minus 24. And if you measure all the papa bears that are minus 24 or more, there's only a handful of them, they're minus 34. So you have to have an environment. If you're looking for a real big correction, the environment needs to be set properly. So here's why the big bear markets happen. They happen for financial systemic risk reasons, a run on the banks. There's been a handful of examples over the last couple hundred years where those have played out and you get much bigger bear markets. The more likely reason you get a big correction is that the markets are extremely overvalued. You're late in the cycle. The Fed is tightening interest rates, and they tighten too much and cause a recession. So not only do you get a recession economically and therefore an earnings recession, you get a multiple contraction. So the long run average multiple for the U.S. market is about 16.5. We're currently trading at 22 times earnings. So if we go, the next recession that hits, whether it's this year, next year, the year after, I don't know, but we're due for one pretty soon because we've now had 8 years of expansion without one, second longest in history. So we're due for one within about a year and a half or so. So it could be late 2018, 2019. Multiples 22 times earnings. In a recession, you get a 20% decline in earnings on average. Sometimes it's more, sometimes it's less. Depends on the degree of the recession. So let's take the S&P earnings this year at $130, and let's take off 20%. So you got $104 in earnings at the trough in the recession. The multiple goes from 22 to 16, so just below the long-term average. 16 times 104 gives you about 1,700 on the S&P 500. We're at 2,600 today. A 900-point correction on the S&P is about a third. So that we're in the environment now for a papa bear. But we were a year ago too, because the valuations were high and the risk factors of a recession were pending. Okay, so the next correction is probably going to be a doozy, and so you just got to understand that. At the beginning of 2016, when the market sold off in January, we were at a level of 1,800 on the S&P 500. Doing the same mathematics gave us a downside target of about 1,700. At that point, you got to start being a buyer down 1,800. Okay, if there's only another 5% to go. So you got to look at that as what's the realistic bottom. Don't do Elliott wave counts. Don't do anything like that. You got to look at where the fundamental value is and where the buyers are likely going to start to show up. 2008-9, whole different ball game. That was never happened before, that kind of event, and who knew how to value the market? But you knew once you were down more than a third, you were pretty close to a bottom. And had people bought once you were into December or January of 2008, 2009, and just plugged your nose for 5 years, you would have done very, very well. Like Warren says, buy when there's blood in the streets. After the average 13.4% correction, growth outperforms value, which means on the consumer side, you sell your consumer staples defensively and you buy your consumer cyclicals, because you're going to get more growth in the portfolio with the cyclicals than you are with the defensive holdings. If you have a lot of dividend payers, like utility stocks, and you go down in a bear market, you're going to go down less with those, but near the bottom, you got to flip them out, and you got to buy consumer cyclicals, financials, industrials, technology, so your portfolio grows when you come out of the correction. Okay. Okay, so I got a few minutes left here before we go to Q&A, so I'm going to speed up a little bit. Anchoring, being fixated on the irrelevant, okay, and this is a big problem for everybody. A couple years ago on the show, this woman called in and she asked for a good bond exposure that didn't have a lot of risk, that was going to give her better than GICs. And I told her to go buy the BMO 1 to 5 year laddered bond ETF. And that's the blue line in price there. The orange line is the total return chart. And a couple of months ago, she emailed into the show again and said, Larry, you told me to buy this, and I was looking for something safe, and now it's down a couple percent. I'm losing money on this. And I sent her this chart back, and I said, you're not losing money on it. You asked me for a bond holding that would give you a better return than the GIC for the next couple of years. And the orange line is actually what you achieved. You actually got your 2% return. Yeah, price went down, but when you have a premium bond, and because bond yields have been falling for 30 years, most bonds trade at a premium to where they're going to settle. So a bond, you'll get 100 back at the end. A 5-year bond trades at 105 and has a coupon of 3%, so you get the yield of 3%, but your yield to maturity is 2%. Because over 5 years, you're going to lose 5%, about 1% every year as it gets towards maturity. So your yield to maturity is 2, but your coupon is 3. Okay? So every bond in that index is going to fall over time pretty much. So it was always going to go down in price. There was never a question that it wasn't going to go down in price. But the realized return was actually what she got in terms of the yield to maturity. So people get fixated on the irrelevant. And the irrelevant, whether you believe it or not, is the price you bought your security at. You have to think about it this way. Okay, maybe this thing I bought didn't work out, but can I sell it and buy something else where I have a higher expected return in the future? But people get emotionally anchored to the price they bought it at, willing to sell at a loss until that loss gets too painful, and then they just can't sleep at night and they're forced to sell it, or it turns into a lottery ticket. But how you got to think about it is, can I take this money and put it somewhere else and get a better return adjusted for risk? That's how you should think about it. But the vast majority of people get anchored to the price they bought it, and they said, well, if it gets back to that price, then I'll sell it. I got a message for you all. The market does not give two beeps where you bought your security. The only thing that matters is the future. And you don't know if it's going to go up and down necessarily. You've got to strategically say, can I sell this and buy something else that's going to do better? That simple. If you can't get around that emotional baggage of being anchored to the price you bought your security at, you're not going to do well trading on your own. So now that you've recognized you have all these investment challenges, what are the solutions? Now I'm going to run through the portfolios with you. So having a goals-based approach to your portfolio is important. Whether you work with a financial advisor or not, it's helpful to work with a financial advisor, but if you don't, you've got to figure out what your financial goals are, how much money you're going to have in your retirement, and what that spending is going to look like for the next 10, 20, 30 years. And you need to gear the amount of risk you need to take to get that average return, and not build a portfolio and not worry about the volatility. Just know that that portfolio on average over 10, 20, 30 years is going to give you that expected return. You can make adjustments along the way, but it's going to help you reach your goals and reduce the emotional cost of investing. If you can't do that, that's going to be a big challenge for you. But goals-based investing is very, very helpful that way. So here's how I think about building a portfolio, and then I'm going to show you how I go about building these. I want to build a portfolio that's going to generate the highest return possible with the least amount of risk. Okay, that's what my goal is. So Harry Markowitz and William Sharpe won a Nobel Prize in 1990 for their portfolio optimization. For those of you who are so inclined, you can do a Google search, Markowitz, Sharpe, Microsoft Excel, portfolio optimization spreadsheet, something like that, and you'll see a bunch of YouTube videos there, and it'll show you how to create a spreadsheet that will help you build this optimized portfolio. And the input into knowing what you should put in your portfolio is an ETF or a stock, and you have to have an estimate of what that stock's forward expected return is and what the risk of that return is compared to the risk-free rate. Risk-free rate can often be a short-term government bond or a GIC rate, call it 1% today. So if I'm going to add something to my portfolio, it better darn have an expected return higher than the cash, or I'd be silly to doing it because it has price risk. So again, as I talked about, what is the downside risk? What is the upside potential? If you can't do that calculation yourself, you have no business investing on your own. Okay, you really don't. So you have to have a framework for identifying what my expected return is going to be in the future by buying Europe, by buying a sector, by buying a stock, whatever it is you're going to do, you must be able to calculate that. If you don't have a chance of having a really good ride or optimal portfolio. Okay, so that's essential. The starting point for building a portfolio is considering the world, except in a taxable situation. So you got a Canadian account, it's taxable, and you want to focus on the benefit of dividends, so you have the lowest tax and capital gains. So you want to do a little trading of dividend stocks, then you can have a higher weighting in Canada. Because when you get a dividend from a foreign corporation, you don't get a dividend tax credit. It's treated as income, and you've got foreign withholding tax to deal with. Okay? In a registered account, doesn't matter what the source is, whether it's dividend, capital gain, or interest from a bond, or foreign interest, or foreign dividends. When the money comes out of the registered plan, it gets treated as income. So it doesn't matter what your source of return is in a registered account. And in a registered account, the world looks like this. 50% US, 3.2% Canada, and that's the rest of the world in terms of the slice of the pie. The Vanguard Total World ETF, I've put a link there for you to go to the Vanguard website and see what the pies look like and how the world is shaped. And that's your starting point for a global portfolio, equity-based. A lot of people ask me, what's a simple way to do this, Larry? So BMO has a ZMI, which is a monthly income ETF of ETFs. And the current weighting is approximately what we see on the screen here. It's probably adjusted a little bit. And it's tactically rebalanced, strategically rebalanced by the portfolio manager. And so they'll increase, when they want to be more aggressive for equities, they'll increase the weight slightly in the equity components there. And I've highlighted the ones that are more offensive in terms of equity exposure, and the ones that are more defensive in terms of bond exposure or lower risk equity type exposure. And so you could build a portfolio like this as a starting point, weight it to the world index approximately, and then balance it as you choose to compared to your own personal tolerance for risk, etc. If you can't do that analysis for yourself, it's going to be a challenge. But in the spring series, the next BermansCall roadshow across the country, we're actually going to dig into portfolios and show you how to do a little bit of this yourself. Okay, the independent. What I've done here is I've taken all global sector ETFs. They all trade in the U.S., so the U.S. dollar is a consideration here. But as a starting point, rather than focusing geographically on what countries to be in, this is a way of focusing on what sectors to be in and overweighting and underweighting the sectors that are more aggressive or less aggressive. You could add, to the degree that you want to add global fixed income into your portfolio. There's some choices for you there. Again, this is just the starting point. In the spring series that we'll come out with next year, we're going to dig much more depth into how to actually manage each one of these portfolios. The accumulator, the higher risk portfolio, tend to be very concentrated. Here's 5 ETFs that represent the world. You can get into doing currency hedging if you like. You can bring in gold or some more aggressive asset classes like the FANG stocks. Listen, there's a whole host of things out there for you to do. If you want to play defense and get more defensive in your portfolio, then having some gold, U.S. long bonds, or low volatility exposure to the U.S. market, might make some sense. Again, just a starting point. And finally, for the preserver, capital preservation portfolios, and the reason I nickname what we do the sleep at night portfolios, here's the current snapshot as of this week, what the holdings are in the fund. I should add, I've added to the weight in gold ETFs, ZGD. We bought some today actually into the portfolio, so the weight's a little higher now for ZGD. And I think gold's a tremendous value right now as it's selling off towards the lower end of the range of the last year and a half. I think it's quite attractive. So in this fund, we overweight the areas that have a good dividend with lower risk profiles. I'm sitting right now with about 20% in short-term corporate bonds. If bond yields back up another 25 basis points, then I'm going to sell some of those short-term bonds. I'm going to buy some of that TLT, because I think when we get a risk-off market and equities overall decline, that's going to give me some of my best protection. As you can see, I'm holding the U.S. market very defensively with a put-right strategy. The current yield on this portfolio is almost 5%. So it's a very, very nice yielder. And you can see the sleep at night nature there. If you remember that efficient frontier portfolio, that Markowitz Sharpe model, again, the highest return possible with the least amount of risk is what we try to do in these portfolios. And then finally, to wrap up here before some questions, what keeps me up at night and what gets me excited? Donald Trump keeps me up at night. What's going to go on with the U.S. tax plan in particular? So we're probably going to get a tax package done, and I've been on record to say it's going to be a sell the news type event when it happens, and ultimately going to be very disappointing for markets. We're starting to see a little bit of that now in the last couple of days with some of these things. I am on record for saying I believe Donald Trump will be impeached in 2019. And I think doing poorly in the midterm elections in November of 2018 will be the impetus for the Republicans to say, listen, you haven't done anything for us, you're very divisive. Well, they'll find something related to Russia or anything else that he's done that'll be impeachable, and they'll go through that process. That might be just in time for the markets to come unglued a little bit in 2019 if it takes that long. Here's what I'm most worried about is the liquidity of the central banks. In the graphic on the right here, we see the size of the G4 balance sheets as a percentage of G4 GDP. And so it's currently sitting at 37%. And you can see that it really took an uptick when the Lehman moment happened there back in 2008. You can see that white line shoot up dramatically. So if central banks were to normalize their balance sheets, you'd be talking about the equivalent unwind here. Now, to the degree that equity markets, and if you look at the orange line here, you're looking at the MSCI All World Index. So I think that as this liquidity comes out of central banks and they're raising rates here, this has a good potential to take us back towards the 2016 lows there. And I think Again, that's about 1,800 on the S&P 500. I gave you you know, an earnings kind of base target of high 1,600, 1,700. That's probably what we're looking at in the next bear market whenever that plays out. And we want to try to avoid some of that if we can. But I've been saying that for a year and a half, folks, and it hasn't happened yet. It doesn't mean don't go out and sell your portfolio and go to cash tomorrow. Please don't do that. But I am running defensive portfolios, and that's how I think they are the most prudent thing to do at the moment. North Korea, what's going to happen there? Well, we saw another missile launch, and apparently that missile type is going to be able to reach the U.S. now, and they think, you know, that he'll get a bit more aggressive. I think the best scenario here is that he's going to demonstrate to the world that he can hit the U.S., and hopefully he's never going to want to do that, and he wants a seat at the table. Now, to the extent that Trump doesn't want to have a seat at the table and the U.S. acts offensively, I can't imagine Japan or South Korea would let the U.S. attack North Korea unless North Korea attacked first. Okay, so unless he attacks first in an overt way, if he launches a bomb towards Guam and it has the impression that it's targeted at a U.S. military installation on Guam, that would be the cause of escalation, where I think the U.S. would act militarily by going in and leveling some of their missile deployment technology in North Korea. That would be the worst case scenario, I think, playing out. So we'll see what happens. Thing that keeps me up most at night is the debt in the world. The debt has expanded dramatically. This graphic shows China's total debt, so the official budget plus all the off-balance sheet financing / infrastructure spending, so the lending in the banking system that's largely controlled by the central bank. So over the last 10 years since the Lehman moment, so to speak, all of the growth in China, 100% of the growth that's averaged around 7%, has been financed by debt. Prior to that, China was growing around 10%. If you go look at the previous decade into the 90s and into the 2000s, and they were doing that with about 4% debt. So there was 6% real growth happening in China, and now there's no more real growth. It's all being fueled by debt. And within China, within the next 5 years, the World Bank expects their population to peak. So the growth story of China, in my mind, is coming to an end, and it's not going to drive global markets like it did. Places like India and sub-Saharan Africa are much more attractive that way. These days, today, there's an ETF for everything. And the last two things here are things that I really, really like. The whole electrification of vehicles and what it's going to mean for oil prices. Now, I'm not buying this lithium ETF now. It's very overbought at the moment technically, and I think at risk of a correction. If it dips back below 30, I like it. Here are the names of all the companies in that ETF. It should be on your radar. If we get a bigger market correction some point next year, I would jump into this. It's a momentum trade right now, and it's been going strong for the last number of months. There's no doubt about that. But again, a bit overbought, a bit of ahead of itself at the moment. And finally, artificial intelligence sector and robotics. I think these are great long-term ways of playing. Both these ETFs, very overbought at the moment. I wrote an article in the Globe a couple weeks back that these are the two things that I would go buy if and when the next correction happens. And I think there will be one, and I want to be a bit patient. I don't like paying high and buying higher. I'm not a momentum investor. I'm a value investor at my core, but I love these sectors strategically longer term. Okay, Steve, do we have any questions that have come in on Slido? And maybe I can take the last 5 minutes of the call here to go through them. So my son-in-law is invested in blockchain-related business, has done very well. Could Larry spend a few minutes sharing perspective on this type of investing? I think blockchain technology is going to revolutionize a lot of the world in financial services. You've seen that Bitcoin is based on blockchain technology. When you're buying Bitcoin, you're not investing in blockchain. So make no mistake about that. Any of the cryptocurrencies, you do not own blockchain technology. You're buying something that, in my mind, has no value. And we'll see how that all plays out. But blockchain technology is brilliant, and it's going to revolutionize a lot of things in accounting, financial services. It's going to cost a lot of jobs, but it's going to create a lot of jobs along the way, and I think it's something. There are no good public markets right now to invest in blockchain-related companies. There's no ETF for it. Again, investing in Bitcoin is not an investment in blockchain. Okay. Do we have any other questions? How will we recognize that the markets are changing and that correction has started? Well, that's a very good question, and everybody wants that crystal ball. One of the things at a market top we look for is the number of stocks participating in a rally. So how many stocks are going up relative to going down? When the market makes new highs, are most stocks making new highs, or just a handful of them? That we look at market breadth. So very few stocks now are leading the rally higher. And as the FANG stocks correct, we're starting to see rotation into other names. So it's not coming unglued yet. But for the first time in a long time, many stocks are now dropping below their 50-day average, or their approximately 3-month average, and it's the highest level in quite a while. So we're starting to see a decay in participation, and that's usually a leading indicator. But I should tell you that we saw a decay in the advanced decline line in the middle of 1998, and the overall markets didn't peak until the first quarter of 2000. So about 19 or 20 months later, then that we first started to see the major divergences building in the advanced decline line. So the tops take a long, long time. The complacency takes a long time. People don't panic at a top. People panic after. So, you know, when it's down 10 or 15%, that's typically when people start to say, "Oh my God, get me out! I got to do something." And then sometimes it's, you know, it's a lot more than that, depending on the individual. So there's no great indicator. There's no one indicator that says, "Believe me, if I had it, I wouldn't tell anybody what it was, because I'd be able to make all the money in the world." And there is no one thing that can drive you. Do you advise going into new ETFs of any types when they're first formed, specifically learning curve for AI ETFs? So I'd be cautious there. I think you want to do your homework. So if you're going to buy the Mind ETF that Horizons came out with, now what that ETF is doing is it's using artificial intelligence to select other ETFs and stocks to do the asset allocation calls. I don't know what the methodology is, and they should, in their advertising material and on their website, and certainly in the prospectus, give you some detail on how it's going about selecting the securities. But if it just says, "I'm using artificial intelligence to select securities," and you don't understand the methodology behind it, I think the trust factor's not going to be there. So that's how I would think about it. Do I have thoughts on gold going forward into the market? Yes. So I try to run my portfolios on what's called a bit of a risk parity basis. And that is, I allocate assets based on their risk. And I want to buy low and I want to sell high. That's my overall philosophy on investing. So as gold is coming off now, you know, maximum exposure for gold in my portfolio is going to be, say, 10-15%. Gold yields nothing. The equities yield almost 1% a year, so almost nothing. So you're not investing them for yield. You're investing in them for growth and capital gains. That's the only reason you own gold. Gold is negatively and low correlated with equities, so it's a diversifier. So as equities are getting more risky and gold's selling off, why is gold selling off? It's selling off because of the expectation that interest rates are going to go up. And as interest rates go up, gold has more competition from yield in bonds and the safety of bonds over the safety of gold, and money moves into bonds over gold. So that's, you know, the whole thing as it puts together. But as equities, gold equities come off here, I'm building my exposure. I'm about 50% or less of a maximum position in gold right now. So gold could fall another $50 to $75 and I'll keep buying into the decline. When equities do come unglued, gold should have another flight to safety bid, get somewhere back above 13.50, and at that point I'd likely be a seller, subject to revaluating things as they play out. Globe article warns not to buy ETFs in December year-end due to tax implications. There may be some good opportunities to buy now. Should we avoid buying as they write or buy? So every year in every mutual fund or ETF, there's a distribution where if there's embedded capital gains and everything, you got to pay some tax and they do a distribution. So it's not a great idea typically late in the year to buy a fund because you may buy the fund and get hit with a tax bill. So that's the reason around all that. But I don't invest for tax purposes. That's not what I think about. I invest for opportunity. And if you're getting a lot of tax loss selling, again, we're going to start to see some of that in the gold sector this year. Sectors that have underperformed, yeah, I think there's an opportunity there. But again, diversify, don't concentrate your portfolios, and think about it that way. You'd never want to hold 80% gold or 50% gold in your portfolio. It's too much in one asset class that doesn't yield you anything. It's different than putting 80% in stocks where you get a yield off the portfolio and you're earning something to hold them. Anyways, we've run a little bit longer than our 2 o'clock, so I've got to call the 2-hour time frame. So I've got to call it here. Thank you all very much for being on. You'll get a copy of the recording, and we'll email that out to people shortly. And that's it.